Have a good chow.
Still dark where I'm at, guys.
Where are you?
Tells you it's fall.
Where are you? In California? No. Wait.
I'm in California, yeah.
Yeah. Still dark there? Wow.
Yeah. It's dark.
At 7 in the morning?
Amen. That's how we roll. All right, let's get this retweeted here quick, guys.
Any symbols for you, Steve?
No, I was surprised by those oil services names and the OIH in particular, Bakes, when you sent that over this morning, just how strong they've been in a shitty oil tape.
For the first time in forever. I mean,
Right.
We'll talk about it a little bit further, but Marston's, our colleague Robert Marston's been all over this. And, and he's found the phoenixes from the ashes. And now, I'm dead serious. I mean, he has the best energy service.
He's got a good screener.
I don't know what he's doing. I mean, I think it's the warming his sternum in his vest by the flower garden. I don't know. It works for him, so it's good.
His velvet. It's his velvet robe.
And he's been on Weatherford forever. It's finally working.
Yeah, he has been in that forever. It was a dog for a while.
Yeah.
Every dog has his day, and it's their day. We'll talk about it maybe further on, but I mean, Weatherford's a component in OIH. I've been sort of head fake because Schlumberger, which I think is the granddaddy of them all, Keith Jackson, has looked like death, and I don't know why it looks like death versus the others. I mean, Halliburton had an okay report, but it was more than okay, I guess, because the stock's popping. I was talking to Bob offline. I think there's been a bunch of times that oil's gone from a 5 handle to a 6 handle, and the stocks didn't care. And for whatever reason, they care now. And I'm really, I've said energy is a waste of time. Oil and gas has been a waste of time for 4 years. And now I'm getting, this is what I did in the 90s. I called for $30 oil when it was 10, and people thought I was out of my mind. This is going to be fun. I like this stuff.
All right.
I like dirty stuff.
All right, let's get this show on the road. Good morning, everybody. Welcome to Wall Street Beats. I'm Steve Lamar. I'm joined today by our technical and charts and flows expert, Kevin Bakes Baker, and our oil and gas pro, Bob Morris. Good morning, guys. Welcome to the show. Welcome, everybody who's joined us on an early Friday morning. So let's get started. We're talking some oil and gas names, naturally, with Bob on the show, but Bakes has been deep in some of those charts here over the last 24 hours at least. So let's start with you, Bakes. What's caught your eye?
Yeah, no, this really dovetails nicely with Bob being on. But here's OIH. I said, there we go, OIH. And I'm going to go to the longer term.
People that don't know, that's the Oil Field Services ETF.
I was getting there. Okay.
So what are the bigger, Bob? What are
As
the
Bob
bigger
said,
names
this is
in
the Van Eck Oil Services.
What are the bigger names in this ETF? What's this? What are the big ones? What are the big ones in here?
Schlumberger, Baker Hughes, HAL, which is Halliburton, and I forgot number 4 and 5. Oh, Tenaris, which is tubulars. For oil drilling, kind of an esoteric one, but a lot of the operating leverage in these things is unbelievable. And to those of you who say, "Oh, Bakes is just a pretty face; it just reads charts," I've done a lot.
That's exactly what we were going to say.
Okay, maybe I'm not a pretty face, but you get the idea. But I've done a lot of fundamental work. I mean, I've gone into the weeds with these things in times gone past. But my thing is, I reverse the chronology. I do the fundamental work when the charts tell me to. And I'm brought to this because I talked about it the other day with Robert Marston, our colleague on the call. Weatherford's the number 6 name, about 4.8% of this ETF. And I would argue, one of the best. this is just starting to. I mean, look at this. I mean, I
Yeah.
think everybody can see what I see, but
One of the best, probably one of the best value plays, probably in that ETF for sure.
from 3 city blocks, this is cheap with positive change, and that
Yeah.
hasn't. We've had cheap for a while. We haven't had positive change, and again, I don't know why going from 59 to 61 matters this time, but it does. And I mean, you've got
Look at
volume
that
pick,
volume. Look at that
right?
volume pickup. Yep.
I mean, in my eye, and this is what I do. I mean, I just my eyes are drawn to this, and I don't care if it's an algorithm. A person wrote the algorithm, so I don't think it is. I just think it's something has changed, and frankly, you know, because I guess I am a tourist here. I thought Russian sanctions were already on, and oil prices didn't care. So what's new about this, Bob? I hope will enlighten us. But we're taking out new highs on decent volume, but a good volume yesterday. I mean, 2.5 times regular volume, and so for the first time in a long time, this group that's what 3% of the S&P, no, probably less. Energy services probably 1% of the S&P. It's time to start digging around here. Marston's been around since the 50s, right around here, and here we are at 71.92. But I would contend this is Weatherford, not OIH. You know, we're this could be a rebound that fails here, but my suspicion is given the daily chart, that is not the case. So
Yeah.
OIH, and the great thing about with these ETFs is then your shopping list is okay. I'm going to go in and look at the top 10. Which one do I like? Number 6 is Weatherford. And by the way, I haven't heard a conference call yet. We're saying, oh yeah, we're going to increase capex at the E&P level. So the stocks are telling you that's coming, in my opinion.
So,
Yeah, and I
Bob,
think
do you have a view on this? We know Marston likes it. We know even Berna's been on this, which
yeah,
is
it seems
out of her wheelhouse a little bit.
yeah, it is cheap. It seems to the bottom. I think part of what's driving this in some of these service names is the international exposure. As North America or the US companies continue to sort of hold things steady, aren't looking to increase production or capex, but sort of run a maintenance type mode. International is where you're seeing more of the uptick in activity with some of these big projects that some of the integrated majors have, and some of these international countries starting to delve into some oil and gas projects. So I think that's where the growth's coming from. And I think that's what the market sort of has missed in the past. It's beginning to be recognized now in some of these names like Weatherford that are cheap, that haven't done anything, that the market says, well, wait a minute, there's going to be some upside here of growth along the international front as companies put money into these international projects. And, we'll delve into this here in a minute with regard to EOG, but even some of the larger independents now are beginning to diversify in the international because I think they realize that they maybe hit their peak or kind of expanded as much as they can from a growth perspective on North America or the US in particular. So you are seeing more interest, more of a pickup in activity internationally. And I think that underpins a lot of these service names getting a little bit of attention here, in particular Weatherford.
Okay. All right, Bakes. What else you got? Do you
Well,
own
and
this
it's,
one,
it's
Bob? Bob, do you own the? Sorry, do you own this one, Bob? Do you own
I do
Weatherford?
not. I do
No.
not.
Okay.
I haven't owned any of the service names. I need to take a closer look. Maybe I should. And, Marston's been right. That's been, I think, his favorite service name is Weatherford. He's been on that one for a while.
Yeah. Well, Bakes is saying they're leaving the station, so I agree.
Right.
Probably a good time to start taking a look.
and I have not. I've been on here for what, a year, give or take, and I have not said that. And so I'm saying it now. This is a pretty good segue since you
Don't
talked
miss
about.
the bus.
Yeah, get on the bus that takes me to you. Um, I can't go one of these things without referencing an old rock song. Shell ADR. Why it's not Royal Dutch Shell anymore? Maybe Bob can give me a history lesson here. But this is Shell, the integrated, and it is the best looking integrated. I think there's been some takeover talk here, if I recall, with
Yeah.
BP again. Bob, you can enlighten us. But look at this. I mean, this is 7 years, 8 years. of resistance getting taken out, and not by much, but it's getting taken out. And so, this to me, and yes, okay, if you wanted to really have guts, you bought it when oil was -10 back here. I didn't have those guts, and I don't think many people did. Some people did, obviously, but this is I mean, look at this chart. I mean, this is pretty. This is a gap up on above average volume, and this is the first time in forever I've seen an oil integrated that intrigued me. And so, 12 times earnings, if that number's right, the dividend yield 3.7, and I just think it's time to. And I guess this is October 24th, you have the dynamic of people saying, hey, we've had a good year. Let's lock it in. Let's fade NVIDIA. Let's fade Google. Let's fade Microsoft. And
not today.
Not today. Yeah. But in the grander scheme of things, if you want to lock in performance and you want to find performance for 2026, people have been talking about this for a long, long time. I think it's finally here.
Okay.
Yeah, and one of the things that Shell did, the reason they're not Royal Dutch Shell anymore is they moved their headquarters from the Netherlands to London. So they had to get rid of that Royal Dutch now that they've gone through this restructuring, moved their headquarters to London. And they've done a lot of cost cutting, and they've been really focused on share buybacks and the dividend and shareholder returns. And that's really benefited them here as they've gone through this restructuring and cost cutting here mode over the last year or two. And they're big in LNG. They're one of the bigger LNG players, which has gotten a lot of attention. But it's really the focus on the dividend and shareholder returns and this turnaround and restructuring that they've undertaken.
Bob, am I crazy, or did I recall at least rumors of
Yes.
a BP merger?
Yeah, and there were rumors of that. I don't know where those stand today, but yes, there were some of those rumors going around. Which,
All
they're
right,
in London.
what else you got, Bakes? Shell's another one that looks like it's moving out. So put that on.
I did. Yeah, I mean, oil is starting. Natural gas. We've all talked about how the long-term fundamentals are great because you need natural gas to produce power for all the data centers. But frankly, natural gas is at 336 when it's 42 degrees in Boston. That doesn't seem like there's imminent demand for natural gas prices. Maybe the strip is more bullish, futures prices. But now we're starting to see oil and gas, not just nuclear, oil and gas, because I don't like to group energy in one big category. We're starting to see things going on, and I think it's going to be fun. And Bob and Robert can help us make some more money as we go forward. I brought this up.
Have you guys been following this quantum computing narrative, and what is that going to do to the data center power requirements? Or is it just too far out? Hard to say.
As Ben says, it's rigatoni computing, and every time he says it, I get hungry and I order bolognese for the table. But that's someone said on CNBC yesterday that rigatoni. I'm going to keep this alive. I think it's $25 million and a $1.5 billion valuation. I mean, it's bananas. It's absolutely bananas. So yeah, we'll see.
So I was just thinking about all the data center demands that we're going to have and the power demands that come from it. What the heck is quantum computing going to do to that? That sounds like it's just going to make it. It's going to make it much, much worse.
Yeah, I agree with that. It's a question of when, and I think that's sort of a 2030 plus, and that's beyond where my telescope goes.
Of course, yeah.
No. All right, one more thing, then we'll go to Bob and his energy expertise. Steve, you and I forget who else the third was. We talked about Netflix, and I said things were so good that they were bad. Remember this?
Yep, I do. A couple weeks ago.
Okay, and it was so extended here at 1282, 1341, and we've got a film of it. I know we do. It's time stamped, and I didn't say that I have insight into the 44th footnote of their filings where, oh, I think the Brazilian tax authority is going to be a problem in 3Q. The thing that strikes me, for the uninitiated, this is the earnings report of Netflix, and they missed, and they don't miss too often. And usually when they do, people say, okay, that's it's still Netflix, and I still use it. But here's a gap
Yep.
down on 4 times plus normal volume. And the refrain from the sell side analysts and the talking heads was, it's just a one off. They disclosed again, in the bowels, they had this Brazilian tax dispute. Well, they decided either to lose it or just to stop it and pay it. So it was 600 some odd $1 million. I think I have that number right. And it was a one off, but the rest of the business is good. The stock doesn't think so. Look at this. This is 3 days of follow through on big volume and cracking the 200-day for the first time since the Hoover administration. I'm making that up. It isn't quite that bad. But look at this, okay? I mean, it literally
Yep.
2023. This was the last time that it cracked the 200-day, and obviously it rebounded from that, and this might be another one. But this volume over here looks a lot different this time. So I haven't really figured out, because the report was just 2 days ago.
So you're not buying the dip bakes?
I buy low. I buy low volume dips on things like uranium that I think are virtually inevitable. That's where I buy dips. But I buy dips.
Not this high volume dip. Let it go. Let it.
Well,
settle.
I mean, this is a love fest. I think, and I personally, their user interface I think is atrocious. So I don't know why it has this kind of valuation and fan base. But this is a problem. This is a break of the 200-day for the first time, and I think some people are saying, "Why do I need this?" Disney already looks lousy, in my opinion. So again, I think we've been helpful here. We said it was so good it's bad, and we didn't know the exact reason. This is why charts help. Now the reason is they're missing numbers, and people don't care why they miss numbers anymore, and that's a new phenomenon for Netflix.
So where does this chart say this stops, Bakes? Is this where should we be looking? If it breaks something, that's definitely get the hell out of the way, or we've already passed that.
Yeah. This not that far away, 105, 1064. 1064. Okay. If it closes below there, then you start looking at these levels down here at 821. But listen to the numbers that we're talking about. I mean, these are like, this is 30% kind of moves if they happen. I'm not saying it's going to happen, but I am surprised it's day 3 and there's no bounce over this one-time item that people dismissed.
Especially in a strong market these past couple days.
Yep.
All right, let's move on. Mr. Morris, what do you got for us today?
So we were on Monday, and oil WTI was below $58 a barrel, and people were growing a little bit nervous. And our view all along is that we're going to be in this range of $60 to $70 per barrel. And I said then that I don't think it sustains for long under 60, although people are worried about oversupply in 2026, but that's well known in the market. We'll see when we get there. But we got a little bit of a pop here yesterday on Trump putting sanctions on Russia's 2 largest oil companies. And that really popped oil back up above almost to $63 a barrel. I think some people were fading that a little bit. And I don't think we're going to get a run up to 70 or any, huge surge in oil prices here, because we have to see how this plays out. And when something like this happens, the thing that I always think of is that the last thing the Trump administration wants is oil at $70, $80, $90 a barrel. And so I don't think they're going to do anything to sort of shoot themselves in the foot to drive up energy prices when that's something they can grab onto as a success here less than a year into the 100%. Administration. And so, what does that mean? How does this happen? Well, this is still in negotiation. And this is the latest thing that Trump's done to slap Russia for not being good boys and trying to work along this toward a peace process or resolution here. And do the sanctions really get enforced? That's the big question. Are they really enforced, or is there a workaround at some point where, yeah, maybe you know, India is prevented from the U.S. puts sanctions or whatever on India to keep them from buying Russian crude, but it ends up flowing over to China or someplace else. I mean, it's a fungible market internationally, and so I think if the market really believed that 1.5 to 2.5 million barrels a day that's produced by those two largest Russian oil companies were to disappear from the market, oil would be at $80 a barrel. If they really
Right.
thought that was going to be gone for an extended period of time. So I think the market really, there was some short covering probably in the oil contract yesterday. I don't think the market believes that oil is going to be withheld from the global market for any extended period of time. And again, this is an ongoing process of, next week we may hear that Trump's met with Putin and Zelensky and they're making progress towards some sort of resolution. It's just every
Yep.
headline is moving oil
What'd you
prices.
make of the U.S. Adding to the reserve? Was it
I
was
mean,
that was earlier in this week?
they've continued to add to the reserves. I think even going back to the prior administration, they'd begun to refill the strategic petroleum reserve. So that's at these oil
So that's not
prices.
really
It's
a tell on price, or is it?
no, the bigger tell on price is China filling their strategic reserves, which they continue to do. That's a bigger impact. That's
Yep.
like 1 million barrels a day or more uh, in the market of them just filling up their tanks and storing crude in their reserves, which they'll continue to do into 2026. So, on that pop yesterday, one thing I did do, and I'm going to talk a little bit about stocks, and I think Banks can pull up a chart. We were talking a little bit about this over offline. But since EOG, I like EOG. It's my second largest position. I'm over market overweight, but I've been looking to reduce that exposure a little bit, just because I got a little nervous coming out of the last quarter with them talking about they did a big acquisition in the Utica. This is not a company that ever did acquisitions. They always prided themselves on growing organically. They're
Yep.
moving internationally. They're doing some projects in the UAE and Bahrain. And it just tells me that they feel like they're sort of reaching maturity or running out of running room in a lot of their North American projects, perhaps, that they've been very good at. And they've been one of the best. And they've still got some very good U.S. Onshore projects. But, the fact that they're looking now to reach beyond what has traditionally been their core competency makes me a little bit nervous. I mean, there are a lot of companies doing things internationally, and so they don't really, maybe technically they have a competitive advantage in going to Iran and UAE, but it's a competitive market. And so I've been looking to reduce my exposure a little bit here. Like I said, it's my second largest position. The portfolio run is across all sectors, so it's like 4.5% of my portfolio. But I'd like to reduce that a little bit. And the way I'm looking to do that is yesterday on that pop, I wrote January 120 calls on part of my position. And I like doing that because if I look back, I own this. My cost basis is 120, although I got to go back and look when I bought it because I also have here that I've made nearly $50 a share in call premium writing covered calls on the stock over time, which is something I like to
Wow.
do. And it's been one of my favorite
Yep.
names to do that. So, I'm well into the money in that regard. But if I can reduce my position by getting out of some of it at $120 a share, I'd probably look to do that, or else I roll the calls or whatever. But I'm just looking at reducing my exposure to EOG a little bit and moving it elsewhere. I'd like to increase my exposure more to some of the gas names or the natural gas side of it from the oil side. And, I've been doing that in names such as EQT and Expand Energy so far. But, again, what I did do yesterday is wrote some January 120 calls on part of my EOG position, just ultimately looking to reduce some of my exposure there, given it is my second largest position.
Banks,
Um,
what is the chart? What is that chart telling you?
I don't like it. It looks like my
Yeah, I was gonna say it
EKG.
doesn't look good.
It looks like my EKG. I mean, here's the
yeah.
weekly. Other than that, Mrs. Lincoln, how was the play? I just, especially as we talked offline, EQT announced yesterday, and they didn't like it for some reason. Bob can opine, but it's holding. I mean, this is a rock steady chart that if they don't benefit from data center demand, then I don't know who the hell does, right?
Yep.
Yeah.
So and then some of the other names, I don't want to steal your thunder, Bob, but Fang is an oily name. Diamondback, that
Mm-hmm.
looks like a base. That's already the knife's on the floor in that case. The knife is still dropping with EOG. What was the other one we talked about? Oh, Devon.
Devin, yeah.
Devon. Okay. See how different these look? Offline, I asked Bob, why does EOG look so much worse than the others? And then I think he answered the question. They're doing stuff they haven't done before, and they're in the penalty box, and you don't get out of the penalty box. This isn't hockey. It isn't. You need quarters, multiple quarters. It isn't 2 minutes for high sticking. It's show me. I'm from Missouri, and show me that this is going to work. And there's just so many other stocks out there that are acting well. I just don't like it.
I mean, when you get this big, and they've been tremendously successful in the past, this has been a great company, but you reach a point where you're so big, it's hard to grow. And they're not really looking to grow per se in the US, but down the road, they're going to have to grow in the sense of replacing what they are producing. They've got some great assets, along the Gulf Coast and in Utica. I think just they recognize that they've gotten so big and they're in this sort of middle territory where they're not a smaller independent that has this huge growth they can dial up in the US, and they're not an integrated oil at the same time either. And so I just would, given my weighting to it or exposure to it, I'd rather move some of that exposure to some of the more gas levered names like Expand and EQT, which are not among my largest positions in the overall portfolio. And EQT, Baker mentioned them. They reported after the market on Tuesday. They did beat. We said they were going to beat. They did beat pretty much across the board. The efficiencies continue to come in as far as drilling faster, cheaper, quicker. All those boxes are being checked. It did not perform that day. It was up after they reported that in the aftermarket that day. But then, given a little bit of a pullback in natural gas prices, all the gas names were down then that next day, and it was really more on the macro. And I think partly people weren't surprised that they beat, just given we expected them to beat, and they do this seemingly every quarter.
Exactly. It was priced in.
And so I think here going forward, what was interesting is during the quarter they did curtail some natural gas production when prices got under $3. They have that ability, and then they said now it's all turned back on with prices popping back up here. But they're looking at maintaining, this maintenance mode going into 2026. In other words, where production is now is basically where they're going to keep it flat through 2026. And they have the ability, if prices really take off, to be able to dial that up pretty quickly. But as Bakes pointed out, they're in a great position to take advantage of all these data center build outs, particularly with their midstream abilities and some of the midstream infrastructure they have, to be as a conduit for their production of some of these projects as they evolve and as they sign up more deals to supply gas to some of these data center projects and look to the LNG market. So, I wasn't disappointed. I'm still looking, if we get any big pullbacks in that name or expand, to look to add to those names. But we get the other names. They were the first one to report this week. We get all the other pure gas names next week. But that's sort of how I'm looking at things. And like Bake said, if I'm going to put money in the oil, given my exposure to EOG, if it's not in the natural gas, I'd put some of it into names like Diamondback, which we do own. Like I said, the chart, as Bake said, the chart looks a little bit better on that one. Chevron, Exxon, we own. But again, it's just that with it being my second largest position, I just want to bring that down a little bit on EOG if I can. And I'm trying to do it through writing call options, which I continue to collect nice premium on in the meantime.
And you're going to start looking at Weatherford and OIH.
I'm going to start to take a look at some of the service names. Like I said, I haven't owned any of them. Is this the runway? Are they going to take off here? I don't know. We'll see. We'll see how. It's more looking at what's going on the international front, I think.
Bob, I'm curious.
All right. Anything else you guys want to cover before we wrap this up?
I just love to have, Bob, as he always does, but, keep an ear towards the CapEx conversation that these companies are going to talk about over the next couple of weeks, and come back and say, hey, the CapEx sounds like it's loosening or not at, the majors, the Chevrons and the Exxons of the world. I doubt they're going to say anything overtly, but I'm curious to see, if you get any clues. Yeah,
particularly among the majors. That's what's, I think, driving the names like Weatherford. But, on the CapEx side, we'll get next quarter all the budgets, or we're not going to get everybody's budgets and outlook for next year here in the next couple of weeks. But what we are seeing, like with UKT, they came in at the low end of their guidance range on CapEx. So these efficiencies in North America continue to drive lower CapEx for the same level of activity. So again, the uptick in the service side has to be really along the international front, other than valuation and people saying, look, things have bottomed here. It's not going to get any worse.
All right.
But in the meantime, we're watching the headlines, whatever, actions the Trump administration is taking.
It'll be an exciting week next week for sure.
Doing anything to bring peace deals, whether it's Middle East or Russia, Ukraine. Those are the things on the margin that can continue to bump oil prices back and forth. Not a huge degree, $1 or $2 here. But again, I think we're largely set to be in this range of $60 to $70 per barrel. So the key thing now is just over the next 2 to 3 weeks watching the earnings from all the majors and E&Ps.
Okay. All right, gentlemen, let's wrap it up. Thanks, everybody, for joining us. Come follow us on wallstreetbeats.com and on passes.com/wallstreetbeats. Have a great weekend. We will see you back here next week.
Thanks, everybody.
Thanks, everyone.
Thanks,
Thank you,
gentlemen.
Jen.
Looks like the sun's up there now, Steve.
Yeah, sun just came out.